welcome back to MMGinvest. In this video, let's go over Jerome Powell's speech on Friday, which sent the stock markets pretty much near all-time highs and will likely help push the markets to all-time highs. We might see that market melt up. Looks like that's what they're aiming for, at least Trump. That's what he wants. And later, after this video, I will upload today, I promise, a TA video. But I want to go over that speech because it was very important. First of all, this is not financial advice. Consult your financial advisor before you do anything. I am not your financial advisor. I could be completely wrong about everything. And trading stocks, equities, extremely volatile, extremely risky. Do not invest in anything you're not willing to lose or lose sleep over. So gold was smashed on that speech, but you know what? We knew it was going to come, right? We knew a pullback was going to come. The previous video, I said it's coming up on a pullback, a correction, so it was going to happen anyways. Do they time these speeches sometimes? Probably. That's what I would do if I was them. Because you can't let gold and silver go too high while the stock market's at all-time highs, because that's signaling the stock market that inflation's coming or a correction is coming, because it is a safe haven investment, right? For hedging against falling markets and possibly bond markets blowing up. You never know. So gold did pull back. By the way, it's really funny. Everyone wants into the private group and they want the research report data when the prices are rising, right? And everyone's FOMOing, fear of missing out. But whenever the price pulls back and falls substantially, or even just a little bit, no one's interested. It really blows my mind. That's exactly the opposite of what you are supposed to do. And that's why retail investors always get burned, literally. It's because I personally don't understand it. I like buying things when they're cheap and when they've been beaten down. Not when they keep going higher and higher and they're hitting all-time highs. So it's human psychology. It's really hard to override for most people. They want to see some sort of confirmation that something's going up. And then even when it's going up in front of them, they want to see more confirmation. And then eventually they can't take it anymore. And then they dive in. And then you get a correction. And it happens every time. And I personally see it every time. Because people interest in my services, right, go through the roof once prices have already been going up for months. And then finally at the peak before a correction, that's when I see the most people coming in. And then there's a pullback and then no one's interested. You even see it through views on your YouTube. It's pretty funny. And you know, now's the time to start looking into my services. Go to MMGinvest. Look at that video. That's an example of what to expect. And service pays for itself. Especially if you listen to me on timing. Timing is more important than anything. Of course, I believe gold's going to 3,000 minimum, but in the long run. But, you know, if you would have listened to me when I was pretty much saying on video, now's the time, and I rushed the data and the report out, and I made the website public, right, at the beginning of this year, and I was like, now's the time, people didn't listen to me. And that was back when gold was at 1,300. And, you know, some of these mining stocks, here's an example. It went from 40 cents and it peaked out at $2. Here's another one. It took off at $4, went all the way to $6.30. Here's another one. Could have bought this down around $1. Went up to $2.80. And these are just a few examples that I have on hand. There's some that did even better. Alright, so let's analyze Jerome Powell's speech here, because it's important, and I will talk, okay? So I'm going to take breaks in between and tell you guys my opinions and what I think. All right?
I shall start.
Please.
Okay, so with your permission, Martin, I'll start just by pointing out that the United States economy has continued to perform well and is in a good place. In fact, we're well into the 11th year of this expansion, which began back in the second half of 2009. It's now the longest such expansion since we began keeping reliable records. And the outlook, the most likely outlook for our economy, remains a favorable one, with moderate growth, a strong labor market, and inflation moving back up close to our 2% goal. All that said, there are significant risks, and we've been monitoring those, including, as you mentioned, slowing global growth, uncertainty around.
All right, so obviously we are in the longest expansion in history for the stock market, and he admits to that. But he's not concerned whatsoever. He does, of course, he needs a back door to get out, right? Just in case things do go wrong. So he's going to talk about the global slowdown in the trade wars, right?
Trade policy and also persistently low inflation. I'll just make a couple of quick comments on that. Mm-hmm. I think we grew at about 2.5% in the first half of the year. For the year, we'll be somewhere between 2 and 2.5%. That's very much driven by consumer spending, which represents 70% of our economy.
All right, let me stop right there. First of all, their target rate is 2% according to their metrics. In reality, it's, who knows, it's probably could be anywhere from 4 to 6% inflation year over year. Now, if you pay attention, he said, the economy's been growing at 2.5%. If the economy is growing at 2.5% and your inflation's at 2%, that doesn't leave much room, and their numbers are off, believe you me. If you go to shadowstats.com, the way they used to measure inflation, in the 80s, that means that the economy is technically contracting, because if GDP growth does not outstrip inflation year over year, a perfect example and evidence, I believe, of that is, have your wages gone up in the past 10 years without getting a pay raise or without getting a promotion? A promotion means you have more responsibilities, you became a manager or a higher up level within the company. But if you've had the same status within a company, same employee status, have you really seen a wage increase? Yes, everyone has, maybe here and there, but nothing substantial, right? So if inflation keeps rising, your wages don't keep up with that, the increase, assuming that you're not getting promoted and you're not working your butt off. All right?
Consumer has been strong. The service sector has been strong. The manufacturing, trade, and business investment side has been weaker, and it's in.
All right, so that's another admitting how screwed up the economy really is. First of all, the U.S. economy is 70%. He just said it. Consumer. It's consumption-based economy. That means 70% of our GDP, the economy, is people buying shit, and most of the time it's things they don't need. That's a problem. That's a huge, huge problem from an Austrian perspective, Austrian economics. He's a Keynesian. And he also admits that manufacturing is down. He also, though, said that the consumer is strong. But if we look at, I'll make a separate video, at the consumer debt level, the private sector debt level, credit cards, refinancing of home mortgages. The consumer in America is pretty tapped out on debt. So if the consumer right now is strong, it's possibly because of all the debt they're taking on through credit cards, taking on auto, home mortgage loans, it's just taking on loans and maxing out credit cards and refinancing, right? So that's my issue. And you always see the consumer strong right before a recession or the business cycle ends, or, this time around it's going to be worse than a recession.
In fact, now sideways to slightly down. It's a smaller part of the economy, and by the way, that pattern of a strong consumer economy and a weaker manufacturing, investment, and trade economy is fairly common now around the world. Meanwhile, our labor market is in quite a strong position. For a year and a half, we've been at half-century lows in unemployment. We've got higher labor force participation. We've got wages moving up by so many measures. The labor market is in a good place. I think today's labor market report is very much consistent with that story. And we've got inflation moving back up.
All right, first of all, if you look at the U6 employment statistics, I've done many videos on this in the past. Out of like 330 million Americans, I forgot the exact numbers. It's somewhere around only 80 million have full-time jobs, and then not the rest of the population. I'm including elderly and kids, and then there's a larger number of part-time employees. But again, it's a consumption-based economy, right? So if the economy goes into recession, stock market bubble blows up, all those jobs just go poof, gone. I mean, people don't go out to eat. People don't need service sector jobs. And consumption-based, a consumption-based economy gives you service sector jobs and people in malls and retail stores. And when people stop shopping, all those people lose their jobs, and then those people stop shopping, and then it's like a cycle of death. All right?
To 2%. So overall, we're in a good place, and the outlook is good as well. I think part of the reason the outlook is good is that the Fed has, through the course of the year, seen fit to lower the expected path of interest rates. That has supported the economy. That's one of the reasons why the outlook is still a favorable one, despite these crosswinds that we've been facing. So you asked specifically about global growth. The global economy has been slowing since the middle of, let's say, 2018. We see that continuing with China and Germany and the EU. There are many factors that are driving that. Trade policy uncertainty is one of them, but it's not the only one. But trade policy uncertainty will be weighing on business investment decisions and that sort of thing. So still, though, I'll just wrap up by saying we see the most likely case for the U.S. and for the world, too, as continued moderate growth. And at the FOMC, we're going to, as we move forward, we're going to continue to watch all of these factors and all the geopolitical things that are happening, and we're going to continue to act as appropriate to sustain this expansion.
All right, so that's what Wall Street wanted to hear. We will act as appropriate, meaning we will lower interest rates if Brexit happens, if the trade war keeps going, if the global economy keeps slowing. Of course, Jerome Powell's going to blame the next recession, depression, whatever it's going to be called, on Trump's trade war. Just so you know. But in Trump's defense, he had to do something about the trade deficit. You can't just let another country take all the manufacturing jobs. Of course, I've talked about this. In order to win the trade war, you have to get rid of regulations and lower the tax rate for small businesses and mid-sized businesses. And the larger corporations, those are international companies. They're not so much U.S.-based anymore. And most of those jobs those international companies create are overseas in China.
Could policy uncertainty for example, the uncertainty related to trade policy and Brexit negotiations be playing a role in dampening global growth?
So I think they are. I think that is the case. We've been hearing from we have a vast array of contacts within the U.S. economy, as you would imagine, and we talk to them every FOMC cycle, of which there are 8 every year. The reserve banks go out, and we've been hearing quite a bit about uncertainty. So for businesses, particularly to make longer-term investments in plant or equipment or software, they want some certainty that the demand will be there. They want certainty that there'll be growth and that their supply chain is secure. And I think we would never comment on trade policy. We don't do trade. It's not a responsibility of the Fed. But I think it is the case that uncertainty around trade policy is causing some companies to hold back now on investment. And so our obligation is to use our tools to support the economy, and that's what we'll continue to do.
Keyword, recession fears. How worried should we be about an upcoming U.S. recession, given all the talk in the media? Do you see a particular shock that could trigger a recession? Yes, please.
Yeah, so we're not forecasting or expecting a recession. As I mentioned, incoming data for the United States suggests that the most likely outlook for the United States economy is still moderate growth, a strong labor market, and inflation continuing to move back up. I went through the numbers. I'll say a little more about the labor market. Payroll jobs are coming in at well above the level that new people are entering the labor market, and that means that the labor market is still tightening at the margin. By so many measures, the labor market continues to strengthen. So the consumer's in good shape, and really our main expectation is not at all that there'll be a recession. I did mention, though, that there are these risks, and we're monitoring them very carefully, and we're conducting policy in a way that will address them. But no, I wouldn't see a recession as the most likely outcome for the United States or for the world economy, for that matter.
Right. Thomas? Challenges facing monetary policy. The Federal Reserve, Governor Powell, is conducting a public review of its monetary policy strategy, tools, and communications practices. What prompted you to conduct such a review?
Yes, so the challenges that central banks face evolve over time, and sometimes they rise to the level where we need to assess whether our policy framework needs to be updated to deal with different challenges. A good example of that is after the great inflation period of the late 60s and 70s, central banks really didn't do a good job of getting control of inflation, but coming out of that came a new commitment to getting control over inflation, which was successful, and the framework of what's called inflation targeting. And I think we've had a number.
All right, so he's talking about Paul Volcker, the Fed chairman back then in the early 80s, right? He raised interest rates to 20%. Right now, the Fed funds rate is, I think, at 2.25. So 2.25%. The Fed, this time around, trying to unwind the balance sheet and to normalize interest rates back up towards probably 6-7%, because that's normal, 6-7%, up around that range. That's normal for a normal functioning economy. And that's the interest rates on all debts, your home, cars, credit cards, everything. So Paul Volcker, because there was huge inflation back then, there was lines to gas stations. There was major inflation late 70s, early 80s. I wasn't alive. Well, I was alive, but I was too young anyways to remember. But some of you are old enough. But you could leave in the comments section what it was like. Anyways, Paul Volcker had to raise interest rates to 20%. Right now the Fed can't raise it to 3% without blowing up the stock market and the economy. So inflation, if it got out of hand and they had to raise it to 20%, by the way, this time around they'd have to raise it even higher, because back then there wasn't such amount of debt. The Federal Reserve didn't print $4 trillion. They may have printed a few billion, not trillions. You see what I'm saying? So if they raise interest rates, I mean, even to 5%, it blows up the economy. Now, to stop inflation, they would have to raise it to, I don't know, like 30%. Who knows? And if that happened, we would get like 1930s style deflationary Great Depression, which I would be completely fine with that, because goods and services would be extremely cheap. Unfortunately, though, unemployment would be massive. Like, who knows? Like, I don't know. Like, really high. 70-80% of people not having jobs, period. So that's the problem. That's how they're stuck. And they've put themselves into this box, this corner.
Of decades now of where inflation has been under control, and actually other economic outcomes have been better as well. So I think if we look back now over the last decade, we again see a new macroeconomic landscape which looks like this. It's slower growth, lower inflation, and lower interest rates. And the implication of that is that central banks will be rates will be closer to zero. Central banks will have less ability to support the economy in a downturn should one come. And this, I think, is the main challenge for central banking now. It's the biggest challenge we face. It's lower neutral rates and lower inflation.
So he just admitted the problem is that interest rates are so low right now for all central banks all around the world. Some are negative. When there is another recession, and a global recession or global depression, whatever they will call it, they can't lower rates much, because there's no, I mean, once you get to zero, you might go a little negative, but that eventually that doesn't work. You can't go into the negatives. I mean, there will be no lending of money at that point, because who lends money where they don't get a return? Anyways, you can't have negative yielding debt. It's like that's insanity. It doesn't make sense. It doesn't work. Anyways, so he's already admitting to that. So the only thing they will have in their so-called toolbox, because they think the car's an economy, or they think the economy is a car, and they have some tools. The only tools they have is lowering and raising interest rates and printing money. So the only wrench they're going to have left in their toolbox will be to print.
We see what's happened in Japan, and now to some extent in Europe. So we thought this was a great time to look at our framework and see whether we can find new ways to address that, new tools, new strategies, tools, and communication.
Let's talk about the interest rate, a very important topic, controversial too. It has declined substantially over the last 2 decades in many advanced economies. What are the macroeconomic implications of this decline?
Yes, so I think really for the last 20 years, we've seen what we would call the neutral interest rate decline by at least 2 or 3 percentage points, and there are people making arguments that it's actually more than that. So why is that happening? It's a lot of factors. It's the aging of the population, which leads to a higher appetite for safe assets and more savings relative to investment. It's low productivity. It's low growth. It's all of those things. And so you get in a world where
in the end, he's right. As the baby boomers age, and those are the generation of the baby boomers globally, Japan as well, and Europe, even China. That generation, they have been sitting in the stock market for decades with their retirement accounts and their pensions and everything. And when the next reset comes, where do you think they're all going to go? So a lot will go into bonds at first because they were taught that in school. But if the bond market blows up, there will only be one safe haven, and that'll be precious metals. Also, central banks are buying precious metals hand over fist. I've been posting it in the newsroom in the free chat group. Links below the video. So that's why I see so much upside to it. All right. I just want to comment on that.
Neutral real rate is low, but inflation is also.
Also, one more thing about the baby boomers and all of their money that's been accumulating, and they have massive profits over the past few decades from this bubble economy since 1971. They also have to start spending their retirement now. So there's no way the stock market could keep going up and up and up for years. And from years from now on. Like, as the baby boomers retire, they need to tap into their retirement, which is on the stock market. That includes pensions. That includes 401ks, IRAs. You understand? They have to start spending it because they're going to live off of it from now on. So where's all the new money going to come from? Millennials? Good luck on that. There's not much more room to the upside. Maybe the short term we might get a stock market meltdown because of lowering of interest rates and money printing by the Fed. But eventually, that money's going to come out no matter what. Just because of the demographics. And the baby boomers hold like most of the wealth. They are the middle class. They are the only retail investors really in the stock market. Of course, there's some millennials, this and that, but they don't have much money. And they don't have much in the stock market. Gen X, they might have a little bit, but I feel like they're a little more nimble. And Gen X they'll get out quick when they see any sign of panic. Gen X is like a silent generation that they're smart, but they're not very vocal, it seems like. Let's carry on here.
Low, and what that means, if you add those two together, you get the interest rate. So the implications are, as I mentioned earlier, that central banks will have less ability to counteract a downturn by cutting rates. Typically, in the United States, since World War II, we've cut more than 5 full percentage points, or as we say, 550 basis points we've cut in a typical downturn. Now our federal funds rate is about 2.1%, so we won't have that ability here. So one implication is that we need other tools, and so when we got to the zero lower bound during the financial crisis, we used quantitative easing and we used forward guidance about the interest rate, and we feel that they worked, although are not perfect substitutes for the interest rate. I mean, I think one essential feature of this, from our standpoint, is not to allow inflation to move materially below target, because if that happens, then that will work its way into interest rates. So we're very committed to defending the 2% inflation target on a symmetric basis. We've seen low inflation become the case moving down, and you get on this. You seem to get on this road that it's hard to get off of, and we're trying not to get on that road and actually defend our 2% inflation target.
So he's saying the target. Okay, so the purpose of the Federal Reserve is to have price stability, meaning not too high inflation, keeping inflation under control, which makes no sense because all central banks do is print money, that's why it's the biggest scam in human history. And he's saying it's important to keep it at 2%. It's already at 2%. Right now it's at 2%. I don't know what it. So, and then he says, because they can't manipulate the interest rates too much because it's already so freaking low. I mean, we're not far from zero, and they're going to go to zero probably in 2020. All they're going to be able to do is QE.
It is now.
Thomas, your policy on... Some have suggested that the Fed consider the impact of its decisions on the outcome of the 2020 presidential elections. Do you consider electoral politics to be a new part of your mandate?
Absolutely not. Political factors play absolutely no role in our process, and my colleagues and I would not tolerate any attempt to include them in our decision-making or our discussions. That's not our DNA. Our DNA is what I mentioned earlier. We're strongly committed to non-political decision-making. We serve all Americans, regardless of their political party.
That's a lie. Past Fed chairmen have all done the same. And they've literally admitted to it on interviews in front of cameras that even, especially Alan Greenspan, he said, at the time, I knew it wasn't the right thing to do, but it was the politically right thing to do. And that's what they all do. They're all political, meaning they will all lower interest rates and print money to keep the current administration in power and blah, blah, blah. Now, right now, it's different because you could tell that Trump and Powell here are at odds because Powell started raising interest rates on Trump's presidency, but they didn't raise interest rates for Obama's. So Trump sees this as unfair because he knows it's going to cause a recession or blow up the stock market. And Trump has literally anchored his entire presidency to the stock market. And that's what they just talked about. And Jerome Powell says, "Oh, we're not political at all." So it's going to be a blame game. At the end of the day, it's decades of central bank policy that has blown a giant bubble and will destroy the economy. And also regulations and high taxes, because that makes the U.S. economy in Europe and Japan, it makes them non-competitive on a global stage, for example, against China and India and other emerging markets. It's that simple, guys.
And it's just simply wrong. The idea that we would deviate from that is just simply wrong. And so the answer would be a hard no, let's say.
Like in Switzerland.
Yeah.
We couldn't agree more. Digital currencies. Are central banks missing out on the challenges, but also the opportunities represented by digital currencies?
I don't think so, no. So I think, of course we're following very carefully the whole question of digital currencies. It's not something that we're actively considering, other central banks more than we are. And for us, it raises significant issues that we'd want to see, carefully resolved. For example, if you think about one currency that was for the United States or for, frankly, a multinational currency, it would really need to be cyber secure because, it's one thing to be able to counterfeit paper currency. It's another thing to be able to hack into a cyber currency and create with a computer however much of it you want. So the cyber issues are quite daunting. It's also not clear to us that there's really demand for this. Consumers have plenty of payment options. They're not clamoring for this.
That's really rich. First of all, the dollar and all fiat currencies, it's like 97% is digital. And he just said, well, we don't want it to be hacked and people could just create as much as they want. Which is funny because that's what they do with governments, right? Just pointing it out.
I don't want to sound like I'm ruling it out, but I think there really are. There's another question, too, which is if people are leaving their money in a cyber currency and holding it there, they're not putting it in a bank. What happens with banks is people deposit their money and banks lend the money out. So what will happen to intermediation, the whole intermediation process? What will happen if everyone's just, investing in this cyber currency? So I would say
he doesn't understand that Bitcoin, it makes you your own bank. That's one of the reasons why it does have a value proposition, right? And we don't need banks anymore. So that's the point of the cryptocurrency revolution, right? So obviously they don't like it. It's competition. You have to remember the Fed, the board of directors of the Fed, those people that decide everything, those are former bank CEOs and bankers. The Fed is it's like a conglomerate of all the big banks. So you guys have to understand how, of course, they're in opposition unless they come up and they make their own, right? So I just want to mention that.
Look, we're in favor of financial innovation. We're following these things very carefully, but we don't see digital currencies from a central bank as something happening in the near term.
Okay, financial innovation. I just want to talk about that as well. All financial innovation is a Ponzi scheme, in my opinion. Like mortgage-backed securities, slicing and dicing them, and putting them into creating like funds and indexes and ETFs of mortgage-backed securities and selling them across the world. That was financial innovation. And, it was a Ponzi scheme.
Thomas, how do you see it?
Well, we looked at that very carefully, and we have a similar view, probably. So we do not believe that it's a very good idea to have a central bank digital currency for the public at large, exactly for the same reason. And we also have a very efficient payment infrastructure in Switzerland, so there's almost no advantage to make a payment with a digital currency, central bank digital currency, for the public at large. What maybe a little bit a different situation. So if we have new financial market infrastructures where banks among them trade securities, and you need to also create some new money that comes from central banks that make this system more efficient. So we are looking at that very carefully, but this is not yet sure. So it's not yet sure whether new forms of securities are more efficient than old ones, and whether this new infrastructure actually need digital central bank currencies. Well,
on the international monetary side. So this is the first question. And the second question concerns the Phillips curve. From your comments, you said things are very good in labor markets, wages are going up, and we're just hoping that inflation is going to go up. Is this just wishful thinking about seeing the return of the Phillips curve, or is there some deeper reason that?
Sorry, so the first question was, our review is not about, returning to a different international monetary framework or even, having a global currency or anything like that. It's really about our domestic tools in our domestic context. So, for example...
So that was interesting because I noticed IMF is the third largest holder in gold. And Powell just said, well, we're not looking at going to a world currency. And so why else would the IMF, hold that much metals if that's not their plan? Maybe he's not in on it. You never know. I mean, you have to understand these people. Powell, he's a puppet. He probably only knows what he's told. I don't know. Technically, he is the most powerful person in the world, though. When he speaks, it changes everyone's lives on the planet. Like, if he came out on stage and said, that's it, guys, I just figured out tomorrow the world's gonna, the entire financial market's gonna implode. The entire financial market will implode, and who knows? Like, when the markets fall like 500 basis points or something, it's like, there's like statistics done that like, hundreds of thousands of people or millions die like over a span of years because they're so poor and life expectancies fall. Anyways, that's funny he said that, right? So, and then he also said that they're not looking at going to a new global monetary system because you have to remember the world came off of, Glass-Steagall and the previous monetary systems, right? Where they took gold out of the equation, Nixon did. So he sounds very confident and believable. Another reason why this speech made the markets go so much higher is because this was the most confident and logical Powell has sounded on stage. At previous speeches and FOMC's minutes, he did not sound confident at all, did not seem prepared. I don't know if they, have him go do acting classes or something, or speech classes, right? But he sounds very confident, which is also scary. You have to understand, if Powell, it almost makes me believe that he believes what he says. And that's actually worse than if he was lying. So if Powell actually believes everything he says, because, these elitist intellectuals, a lot of them do believe their own crap. If he believes what he says, that's way more scary than if he's lying. Because if he's lying, that means they have a plan. At least they have some sort of plan. If he actually believes everything he's saying, they might not have any plan for when shit hits the fan.
We're looking at strategies where there would be a makeup for inflation below target. This is an idea that's been around for a couple of decades. The idea is that if inflation is meaningfully below target for a sustained period, then the central bank would communicate so that people understand that there will be a makeup period, meaning a boom of inflation above target. And if the public understands and acts upon that, it'll actually limit the damage from the recession.
All right, he just admitted what they're going to do and what they're planning. So they're prepping the markets and investors and human psychology on this. They're saying because inflation for the past few years has been below 2%, which is a lie in my opinion, that means that inflation could go above 2% for a short period of time. So that's sort of an admittance. Listen, I think they do know what's going on. I think he's lying. He's just really good at it right now on this speech. And he's prepping the markets for above 2% inflation, which in the end, it's probably going to run away from them. And it's going to be, who knows? You never know. And it's going to have to, inflation's going to have to seriously go up by a lot. Listen, guys, there's so much debt. The only way to get rid of it is to inflate it away or default on it. And what's the easiest course and route for politicians and governments? It's to inflate the debt. Because it creeps slowly. It's not as abrupt. People don't notice it as much and as quick.
And it's a great idea. The reason no central bank has really done it is it's hard to find a way to implement it practically. So we're looking really carefully at those ideas. That's a classic idea that we need some of those ideas to work at the zero lower bound. I'll talk about the Phillips curve briefly. So there was 50 years ago, there was a close relationship between the level of slack, for example, the level of unemployment in the economy, and the level of inflation. That has gone away really. It's still there, but it's a faint heartbeat. It's not what it was, and there are a number of possible candidate reasons for that. One of them just is that central banks and have kept inflation under control so well for so long now, really particularly the last 25 years, that inflation expectations are well and truly anchored, and therefore inflation doesn't go down much when the economy is weak, and it doesn't go.
All right. I've been alive long enough to see how expensive things have gotten. Groceries, right? When I was a kid, like $100 would buy you a month's worth for a family of 3. $100 is like what an average person eats for one person a week, easily. So I don't know how they've kept inflation under control for the past 25 years. The dollar has lost like 99.9%. I think it's somewhere around like 95% since its inception. Also, a lot of the inflation that he's saying hasn't really popped up noticeably for the public, at least, to start rioting. A lot of it went into the stock market. That's why. And it also went abroad, all over the world. And emerging markets have borrowed dollars. And, when the dollar falls, that money's going to come back to the U.S. And then you're going to see inflation runaway that they can't control.
Up much when the economy's tight. And I stop there.
No, well, I'm not sure, but probably you are alluding to the fact that we have also a dollar dominance in the international monetary system. And there is sometimes a discussion about that, but this is the result, I think, of the economic dominance of the United States and in financial markets. And in fact, you can only change that if other regions gain in economic importance, otherwise you cannot order that. This is something that has to evolve, and it's a fact that we have also a banking system globally where dollar funding remains one of the dominant funding sources. And as long as this is the case, the dollar will be by far the most dominant currency. And this even increased during the last couple of years during the financial crisis. And this will only change once the economic importance of Europe will become bigger again. And then the other currencies may also gain importance. But otherwise, I think it's very, very difficult. This brings me to a point that for emergency situation, the liquidity distributions among central banks is something that is absolutely clear. So the swap agreements that exist between all major central banks is really one major element of this safety net of the international monetary system.
Mr. Jordan, why don't you give every Swiss citizen 500 Swiss francs in new printed 100 Swiss bills, because that would help the consumption and it would lower the Swiss franc?
But it's a very good idea. And if we could, we would do it immediately. But it's against the Constitution, against the law. This is not foreseen that we give gifts to the population. This is not something that makes sense. And also to say that in the situation that we are at the moment, ideas like helicopter money, etc., doesn't make really any sense. So we are in a situation where unemployment rate is 2.3%. The growth is something.
You know what's funny? They probably will come out with the helicopter money eventually. They'll first bail out the banks again, or their friends, and you already see candidates right now. Candidates for the 2020 elections in the U.S. at least. And there's been talks about it all across Europe. They've done tests. By the way, the tests show that it fails. And they might start cutting people checks or allowances or something. And like the Wu-Tang or the Yang Gang. Of course, people are retarded and they don't understand. That would cause massive inflation, and the money wouldn't be worth anything. It's that simple. You give everyone an extra $1,000 a month, everything, the cost of everything goes up instantly, and it's like you never got it. It's that simple.
Between 1% and 2% on average over the last couple of years. So this is relatively a good situation. So when we give you 500 Swiss franc, then somebody else comes, we would like 1,000 Swiss franc. We have a good project for this or that, etc. And at the end, these are not decisions that should be.
Follow up about the Libra project and the Fed's working group that's tracking the project. When you mentioned the burden of proof that falls on the project, can you speak at all to how the association has been meeting this burden of proof? Anything at all on this visit?
Yeah. On Libra, there's not a lot I can add. We do have a working group among all sides, and we're going to focus on using our tools to do the best job we can to achieve the goals that Congress has given us under the law. That's all we're going to focus on. We don't get involved in other things like that. So,
all right. So in the end, he sounded very in charge. The market's like that. He said they'll do what's necessary to keep the expansion going. That's what he said in the end. And that means lowering interest rates. And that's what the market needs to keep going higher. It's that simple. Smash them likes. Leave anything in the comment section. It helps my videos. Please share my videos if you want me to continue to keep doing this. It's the only way my channel grows. And stay tuned for the next video. Likely today. Will be today. On price action. TA. For precious metals and the stock market.